Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I will be your host for about the next 25 minutes here on Options Guide TV. All right, let's jump right into it. We got a trade that we need to close. So if we're looking at AMD, they announced earnings yesterday, very strong earnings report. Stock gapped open afterwards. So the semiconductors are still where you want to be. You're going to get some volatility, but you have to own some of them in some stocks in that sector, in my mind. Micron Technology keeps setting all new highs. And then you go over to the AI space and you're seeing strength in Google. You're seeing strength in, what was the other big stock that has been doing well? Amazon. Amazon has had a strong showing, and Amazon's real interesting because they've came out and caused UPS and FedEx to actually go down quite a bit because of their announcement that they're going to make their distribution center and their process basically available to almost all companies that are around there. So Amazon still continues to be a leader in the space, and that's just a strong. So with Amazon, you got the retail client, you have a low cost leader. In case we're heading towards a stagflationary type economy, right now that word hasn't been used a lot. It was brought up not that long ago, but there's still some headwinds. Even though the market continues to set all-time highs, we're still seeing highs in oil. We're still seeing layoffs. We had obviously the situation with Spirit Airlines this week. So the VIX hanging around the 17 level is befuddling to me. I don't quite think it really displays the actual risk that's out there in the marketplace. And as a matter of fact, I don't really mind actually buying long VIX calls. That's not a bad trade, and maybe we'll place one. Maybe we'll put some in. When the VIX was trading right around 25, we got short the VIX, did very well on those positions. We did a couple of open wing butterflies, even a few just buy long puts going further out in time. And I think we can do that again. I'm more interested now in that something's got to give in the Straits of Hormuz. Now, the path of least resistance, if you I don't know, believe in the administration, the path of least resistance is that peace is going to come sooner than later. But all it takes is just one event to happen, and you can get that big spike up in the VIX. So I don't even mind just buying long call options. I'm not a big fan of doing spreads where you have limited upside in the VIX, where you're buying a call option at a lower strike and selling one at a higher strike, a vertical, a long call spread, because then you're capping your upside. The thing about the VIX is that it's at 18 now and it could be at 36 tomorrow. And you don't want to cap yourself on it, but it's expensive to do that. So we're going to look into all that trade. But right now, we put on AMD. We did a very successful trade. AMD is up 13% today. And so let's run over to the Tradio Pro software and let's just talk a little bit about that trade. And if you have any questions, please do put them in the chat box. More than happy to address the questions. All right. AMD soared 15% after earnings, and they're up stronger today. Strong Q1 earnings report and bullish Q2 guidance significantly outpaced the tech sector's recent rise in general. So the tech sector's up a couple percent, seeing AMD just cranking it at this point in time, along with Micron Technology, MU. All right. So let's look at the position and let's close the position. Okay, so we're going to go over to the options grid. The what if calculator, and we're going to just take a quick peek at the trade. This is the trade as of today. Now, remember, it's not showing the profit and loss graph for what we paid for it. We paid around $3.50, somewhere in that range. And now it's trading for $7.85, which has actually got to trade for $7.50. You're not going to get a fill at that price. $7.50 is the most that you can get for it. And so we were down here when the I think we were at 345. Stock cranked all the way up. Now we're all the way up here. And at this point in time, the difference between the strikes, right? This is 15 points. This is 7.5 points. So 15 minus 7.5 means that this has to trade for 7.5. So we're at this point where the time premium is eroding. It expires on Friday, the 8th. And so we're almost there. So now you're not going to get 750. 750 is the maximum you can make. That means that you are giving the market maker absolutely nothing. So they're not going to fill that trade at 750. So right now, if you wanted to, you could go in for 745, but I would just leave it there for a minute or two and see if it just actually executes. If this is, remember that we're in a paper trading platform, so executions aren't going to be as accurate, right? But I'm definitely not going to get that fill in this position, and I think you can get 740. I think you can get 740 at this point in time in the real world, but nothing's a guarantee. But we never execute butterflies at the market. We never buy them at the market. We never sell them and close them at the market. So in this instance, we have the AMD position on. We have the 350, 365, 372.50. We're selling to close the 350, buying to close the 365, and selling to close the 372.50. And boom goes the dynamite. Order has been sent to the floor. I'm going to put it in at 740. I'm going to make sure that that gets executed. Now, I've done trades like this before, and where they blow the market away. You're deep in the money. You doubled what the position that you had on. You had limited and known risk. Remember that we paid $3.50 for it, and the option contract, like the 350 strike call, was trading for like $14. So it was extremely expensive. Let's kind of curious where that is at right now. We need AMD. So the most just to show you, with a couple of days remaining, the most at the money option contract is trading now for $11. 413, yeah, that's just 1 point, or the 415 just out of the money is still $10. And you have all day Wednesday, all day Thursday, all day Friday. That's the amount of premium that's still in the at the money contract. So we would have paid a ton of money on the 350s. Now, obviously, well, there's our position. The 350s are doing well, right? They're trading for $60 now. So when you put on the trade, I don't quite remember what our expected move was, but if you did pay $15, $20 for it, you obviously did better if you bought the 350 call than our butterfly, but then you would have been risking $1,500 per option that you bought. So I like butterflies around earnings on expensive stocks. And to me, anything over $200 is an expensive stock. That's what I would classify it at. $100 is not bad either. But, you're not talking about a $50 stock, $60 stock. They're still interesting, butterflies are, but you get added premium from the price of the underlying being higher. You also get added premium, obviously, from the known event, the earnings report, and that will pump up implied volatility heading into that report. So very good trade in AMD. We'll execute that one. Now we have a trade in Disney, and Disney is up today. And we put this on at the last moment, if you will. It's up $8 today. It's up 7.36%. And we said, well, Disney's going to be announcing, so let's go in and just do it before the open, as opposed to, well, if it would have been after the close, we probably would have set it up today. So Disney I think it was just ready to bounce. And that's kind of what I saw on the chart. So let's pull up Disney. And we see the little pop in the underlying stock. It obviously traded within a range between 80 and 120. If we get to 120 here, if we could, I'm not saying that that's feasible, but this is obviously an area of support. You have this huge down move, almost a gap down, if you will, in the underlying stock. And then if we get above the 125 level, you could almost buy some calls here and say that that's a breakout. So that's a level that you would be targeting. But we just sold the put spread, and we did well. Disney, an 8% move in Disney after earnings is a very good move in that underlying. So we need to close that position out. Well, and I also wanted to say with the AMD trade. Well, I'm going to come back to it. Okay. Let's go back to the portfolio, and let's grab the Disney position. Actually, let's do it from the what if calculator. Okay. We have the Disney position in here. So what we did was a short put spread. Stock was at 102, and I kind of build it as on Disney. Is now the time to get long Disney, and build it a little bit that way, in that would you be willing to buy some? If you were willing to buy some, we're going to sell a put spread saying if Disney has not as good earnings, you can buy 100 shares of it around 102, and we got a lot of premium for this trade. We were 4 points wide. 102 down to 108, and we were getting about almost $2 on the trade. We almost got 50%. Well, we got 40% of the width of the strikes. I remember doing the math on it. So real good premium on it, almost a 50-50 trade, and we were still out of the money. But that you can get trades like that around earnings because of that known event and because of the way volatility is. So you can find trades where you get almost the width of the spread by selling an at the money put spread. Like the trade, like the setup, we executed it on Monday, knowing that they were going to announce earnings this morning. Earnings were obviously perceived as good. So now want to close the trade out. So let's send this down to the trading floor. And I can't forget to come back to AMD because I did want to say something about it, though. And I want to talk about a trade that I had on. Okay, so it was 4 points wide, and we received about $2. We'd be closing it for about 50 cents. We have we went out a little further in time, which is okay on a short put spread. It's different on the butterfly. You still got a very solid delta. I think we might let a little bit of time decay erode. Okay, so here's what I would do on Disney. So we have the Disney position in. It's at 58 cents. We've got a good chunk of it. I think implied vols, where are they trading at? They must be high still. Let's go look at the position. There it is. Okay. Yeah, so we're 26 vol there. We're still 31.44 still in the front month. 26 vol. Let's give it a day or two. So here's the way I'm going to send the order. We're going to actually enter this as a good till canceled order, and we're going to try to buy it back at about 30 cents. That should be very feasible. And we'll give it a few days. Now, you could enter it daily, just because if Disney runs up and they're still not giving you the 30 cents today, then maybe I might not want 30 cents tomorrow. I might want to try to get something better, a little bit lower price. But I don't mind putting this in at 30 cents. So I'm going to leave it in as good till credit, good till close trade. And I'm just going to leave it sit in the paper trade account at a net debit of 30 cents to the account. So we need to close this trade out. Let's go into the portfolio. Let's just grab it from here and make sure that it's right. So the close, buy to close, 30 cents, 0.30. I'll take that all day long in the paper trading account. And boom goes the dynamite. Order has been sent. Okay, so wow, we filled. Oh, it was 0 fill. But what did we fill on? We filled on something. No, we haven't filled yet. We're still open on both of the trades. So we're going to leave the Disney close. We still just have some time. We need some time we need some vol to come off a little bit, and then we should be able to close this for about 30 cents. All right. So now with the AMD trade, and I'll just leave this order in, and we'll just focus on it right here. If the stock came back to 365, we would be okay. So let's run back over to the what if calculator, pull it up. So the stock is here. Now we could get out of the trade. Like you notice here that the profit and loss with volatility as high as it is, and we did the short-term trade. So as Friday approaches, we could actually make more on this trade, and we don't have a ton of risk. If you do this, you want an alert set right at the 365 level, and you do not want AMD to come down. So if you're going to do this actively, if the market does come back this range, we got our little teepee and our butterfly. We got the peak of the mountain right at $365. So it's okay to keep this trade on, because if it continues on up, we can still make our $7.50 all the way up from 370, well, $372.50. That is our highest strike. If it comes drifting on down, we could actually sell this thing for somewhere close to 15. Well, that would be the maximum. But even if we could get 10 or 11 or 12, we have zero risk at this point in time if the market comes down. So did want to say that. But now I've done trades like this where they get deep into money. And I wanted to bring this up because this did happen, but it was on the put side of things, which are much more apt to get exercise. But they got so deep into money that exercise and assignment occurred. It was on a FedEx trade. FedEx came out and they announced this is when they were getting rid of the Amazon contract because they realized they were not really making any money. They made too good of a deal for Amazon. And they announced that and said that we're going to need to restructure that contract and think about the business. And the stock collapsed. I mean, it really dropped. It was FedEx. It wasn't UPS. It was FedEx. And the market went way down. And there were only 2 days remaining to the expiration. And I did bring it up on the show, and I kind of said something like this about it. But I'm like, if you just don't want to trade it, you just trade it. But don't forget that early exercise is a thing, especially in equity options. That's one of the beautiful things about index options is that they're cash settled. And the trade got exercised, and the person called up their brokerage firm, and the brokerage firm said, you need to make good and bring in enough cash to be able to buy FedEx. And the answer was that was not correct. You actually just needed to exercise your puts and sell the stock that was put to you. That's why the brokerage firm let you put the trade on in the first place, is because you were covered. You got put the stock, but all you had to do was say, okay, I got put the stock today, exercise and sell on the other side. And as a matter of fact, it was a gift that you were put early, because then you didn't have to deal with any of the bid-ask spreads, and you could have actually made the maximum on the trade. But instead, the person was told that they had to send the money in and pay for the stock. And so they did that, and it became a huge debacle from beginning to end, because then they ended up selling the puts, and they got burnt on the put options because of the wide bid-ask spread, and the market bounced back a little bit. It was a real debacle. So I say this on AMD about it coming up to this range, but we're getting deep enough in the money that exercise and assignment could be a thing. And I almost forgot to mention that. That's part of the reason why, especially on Options Guide TV, I just want to tell people to close it out. So if we go all the way down to the 350 strike call, this is the one that you're in control of. The 365 is 44.90 by 43.65. So it's not an outrageous bid-ask spread. In the FedEx position, it was worst, and it was on the put side of things. Now, if you'd like to learn more about what I'm talking about, look in my website, optionsplaybook.com, and look at early exercise and assignment. There's a section you can actually search for it in the search bar. Just type in early exercise and it will pop up. And it will tell you that on the put side of things, it makes a lot more sense for them to exercise. So if I exercise a put, I get cash now, right? I'm not spending cash. I exercise that put, I get cash now because I'm selling stock. If you exercise a call, you're paying cash now. A lot more enticing to get cash now than to pay cash now. That's the best way I've came up with it over the 20 plus years of teaching options to try to explain why puts might get assigned early as opposed to calls. I exercise a put, I get cash. I exercise a call, I pay cash. And but with that said, that is still a risk. And if it happens, don't panic. All you have to do is do what they did to you and exercise on the other side and exercise your long call here and exercise your other long call, and you end up selling the stock or buying the stock. You would actually get the stock called away from you, and then you just end up buying it at those prices. No matter what the brokerage firm says, because sometimes brokerage firms look at it in a vacuum and they just look at this one event that happened, and they don't look at the whole position. And that's not a good brokerage firm to do that. That Tradier has got a very good option traders, on the desk. I know a lot of the guys on the desk actually from many years of being in the industry, and they would try to manage the risk in I would think in a good way. Let's just put it that way. But you never know. You don't want to leave it up to the brokerage firm. So I guess the moral to the story is this doesn't come without risk, and that risk is early exercise when you get this deep in the money. Okay. I don't have another trade that I want to put on today. Looked at Coinbase. Uber announced, where's Uber at this morning? That's going to be I haven't looked at Uber. I was going to consider Uber, but they already announced. Uber just should be interesting. Where are we at in Uber? Okay, symbol already exists. All right, so where are you? We'll do it right here then. Looks like we're slowing down on the position. There we go. All right, up 8%. Go Uber. That's good for you. That's good. It's good for the stock. Not bad at all. Thought that they were going to struggle a little bit in this. Yeah, nice solid move to the upside. Interesting right here, right where they're at right now. I wouldn't doubt that it closes very close to this. You see the top. This is the most recent high, and it came up and bumped up against that 1, 2, 3 times, and this is a gap down. So this is a very interesting area. Let's do something fun. Okay. We'll make it a paper trade today. They announced earnings. I just like where the chart is at. So this is off the cuff. We're going to sell a short call spread. And I'm not going to do 2 days because then the trade won't be around by the expiration. I don't mind it. So you're looking at 45 cents by selling the 80s and buy. Yeah, this isn't bad. So I'm going to throw it in. Let's toss the short call spread in. Yeah, you're getting 50 cents on on a 2-point wide spread. That's not bad at all. 0.5 divided by 2, 25% for 2 days. But that's a risky trade. So the zero DTE people out there, you're getting a lot of premium still. So look at the vol, yeah, and that explains it. The vol is still at 55% on these option contracts. You're selling, well, the most at the money is 55, but you're selling a 38 and you're buying a 20. Then there's a 20% chance of it reaching above 82, and I think that's a little bit more accurate now. Deltas are going to be a little bit more accurate when that known event is over with. But I'm going to also look at the May 9th, and maybe we go a little bit wider. Let's see if we do let's clear this out and sell the 180 by the 84. 55 cents. And that's not quite as good. Divided by 4, we're looking at 13%. Yeah, I don't like that one as much. See what happens if, no, that's what's wrong. We're buying 2 of those. Nah, that's way better. That's way better. 110 divided by 4, almost 30% of the width of the strikes. 79. And vol's going to come in. What's the 2-point wide one? I think we're going to do 4 points wide. And let's look at the 2-point wide one. Okay, come on. I need you to move. 66 cents. Then we're getting really close. We're 33% on the width of the spread. All right, let's do this one. This is going to be our paper trade for the week. We're going to go out to the 15th expiration. Vol, so we're getting a little bit less vol premium, but I still think the vol is going to come down. We're selling 42, buying 28. Oh, no, in the vol 40. We're selling 40, buying 41. What was this back here? We're getting 54. You know what? Let's do this one. This is the vol. I was looking at the delta as the vol. Let's sell this. Let's get this premium. I think we're going to finish below 80 today. And I think tomorrow this is going to collapse. And we can do it with minimal risk. So let's clear. Let's hit this bid and buy this one. My mouse seems to be a little click happy. Okay, 52 cents on a 2-point wide spread with 2 days remaining. Decent support around this area. Okay, we got one up to, yeah, right here. It'll be big if we just hang right at this area. 87.80. That's right where we're at, and we're struggling to get through that. And this is the bottom of this breakdown here is right here. Here's the channel. Here's the gap area. Yeah, this is going to be a real interesting area. I like this trade. This will be the official. We'll make it an official paper trade, and we're going to send this to the floor. Okay, here's what we're looking to do. Uber announced earnings. Uber is up 8.21% today, or $6. It's trading at $78.91. We're going to go just a little bit out of the money and do a very short-term trade. This won't be a zero DTE trade in that it's going to go until the Friday expiration. So you have rest of the day today, Wednesday, all day Thursday, all day Friday before it expires. But we're going 2 points wide, and we're bringing in about 50 cents. So you're talking about 33% of the width of the spread for a 2-day option contract that the known event is already over. Vol is being sticky because it's made a real strong move to the upside more than likely. And we're going to try to take advantage of the fact that if we can stay below the 80 level, that vol will probably collapse tomorrow. And that's why we're going to look at a very short-term, short call spread in Uber heading into the end of the week. And right now we're going to send this to the trading floor. We'll send it in at 0.50, right at the midpoint, and boom goes the dynamite. Trade has been sent to the trading floor. All right, that's it for this edition of Options Guy TV. If you ever have any questions, please do put them in the chat box. And I want to promote the Friday event. We're talking about Fundamental Fridays. If you'd like to learn more, we're walking through an Apple position. Right now, we're kind of focusing on strategies that enhance your stock portfolio. And this Friday, we'll have another event. You can ask questions live while we do it. Let alone, if you sign up for a Tradier paper trading account, you can paper trade right along with me. And we will send you out the fundamentals of option trading, a 4-part series that I put together specifically to go along with the Fundamental Friday event every Friday on Options Guy TV inside the Tradier Hub, hub.tradier.com. It's free to sign up. Go check it out. They're never going to be charged a fee for, well, never say never, but the plan is to never have a fee to be able to participate in the education. And boom, we got filled on an Uber trade. Nice. Like it. Net credit. We'll look at that trade next week. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.